Hello, thank you all for joining us for today's Winston Baker webcast. I'm Catherine Winston, and you'll meet my co-founder Amy Baker through the comments section, helping with any questions you may have. Before I introduce our special guests, a brief intro on Winston Baker. We've been specializing in producing educational events and networking opportunities around the world for the entertainment industry for over 12 years, and really appreciate you all for joining us here today. We'd love to know who's in the audience, so let us know what you do, where you're calling in for or video conferencing from on the right-hand comments. And as part of webinar etiquette, please keep all comments professional or you will be logged off. Also, as a heads up, there'll be Q&A at the end of the panel. So as you think of questions along the way, just click on the Ask a Question button down below and type in your inquiries or vote up questions that may already be on the list. So enough of the logistics. Let's get to the good stuff. Let's talk money and the venture capital landscape. Now, last year posted a strong year for the VC ecosystem. So it's hard to imagine the industry be facing a new period of transition as a result of the global pandemic within just a few months of 2020. The top line numbers from the venture industry in Q1 2020 might not reflect a major disruption since the COVID-19 chaos came into full effect in March when venture deals were already in progress. However, the global pandemic is having a massive impact on startups, on late stage companies, VC investors, just as it is with the rest of the world. So today we've put together a great group of panelists. You'll be hearing from Chris Hill, a principal at Comcast Ventures who holds a diverse range of experience in SaaS, consumer marketplace, entertainment, and real estate technologies. Got Holly Liu, a founder who built and sold a billion-dollar gaming company recently, Kabam, as well as advises and invests in tech startups. And Vinay Singh, a partner and chief operating officer at Archer Gray, which is a production, finance, and venture investment firm. Welcome, and thank you all for being here.
Thank you, Catherine.
Now, since I've only briefly introduced each of you, I didn't do enough justice. I'd love for each of you to dive deeper into what you guys actually do, who you are, what you've been up to, what's keeping you busy these days besides the back-to-back Zoom calls, the homeschooling, and Chris, just getting married. So congratulations on that. But yeah, let's dive into what each of you guys are up to. Let's start with Holly.
Sure. Hi, everybody. As Catherine said, I'm Holly. I co-founded a company in 2006. We started as a corporate social network, but exited as a mobile gaming company. We actually have a Kabam alumni here too, Rob Oshima. Sorry, I just called you out on the chat. And it was a crazy ride. We sold in 2017 to Netmarble, a Korean gaming company, as well as Fox Next. And then I spent about 2 years at Y Combinator as a visiting partner, so able to see a lot of things that have kind of come through. And now currently I'm helping Mozilla build their incubator. They just launched recently, and they're there to keep the internet free and open. So it was definitely a mission I could jump on. They're like, we need some help. I go, absolutely. So they're also launching a summer program. So if there's anybody out there who is interested in learning more later, you could definitely DM me on Twitter. I'll give you my handle later.
Awesome. Chris, what about you? Oh, mute. You're on mute. We've got it here. Let me see if I can. You're still on mute.
I can go, and Chris can figure out the mute.
Right. Hi, Vinay.
I'll just jump right in. Hey everyone, I'm Vinay. Thanks, Catherine and Amy, for having me. By the way, I always really enjoy these, and I miss doing it in person, but I have to say the virtual ones are really great, and I enjoy the kind of live interactivity. So thank you. So yeah, I mean, Archer Gray does two main things, I would say. You could think of us as kind of content producers, and probably best known for making feature films. So most recently, we had a film called Lost Girls that we did with Netflix that is on Netflix. Plug for the movie. But you might have also seen movies like Can You Ever Forgive Me and 20th Century Women, and going back a while, Mr. Holmes and things like that. These are movies that we developed and produced. And then on the other side, we're an investment firm primarily focused on investing in tech startups in the media space, but also, what I would call some other special situations and some content financing. But I spend most of my days focused on the tech side of things and looking for kind of pre-seed, seed, Series A, early stage companies at the intersection of tech and media, and increasingly through the lens of financial services as well, which is kind of a nod towards our sister company, a company called Anthemis, that is a financial service focused firm. It's an early stage investor, and kind of we found our theses kind of colliding in interesting ways as financial services starts to embed itself in other industries. So I spent a lot of time in the last 6 months, especially kind of before and during COVID, thinking about how those two worlds collide.
That's great. Oh, and you were unmuted yourself, and then you muted yourself again.
There we go. Yep.
Press it again. There you go.
Okay, I'm realizing I'm looking at the lights and they're totally opposite. Apologies. Okay.
No worries.
Hi, this is Chris from Comcast Ventures. Excited to join and participate for today. So I work at Comcast Ventures. We are the corporate venture arm for Comcast, the corporation. That includes NBC, Comcast, and then separately Sky continues to have its own venture firm called Sky Ventures. We are a corporate VC in the sense that our money does come directly from Comcast. We have no outside LPs, but we're unlike most corporate VCs in that we have a broad financial mandate, not just clearly strategic. So we're looking across everything from media, gaming, to frontier technology such as blockchain, quantum computing, to traditional venture startups in areas like SaaS, direct-to-consumer, and fintech. So it's very, very broad-based. And one of the things that we do try to do, though, is take our resources at Comcast and create competitive advantages for our portfolio companies. So we do have a huge footprint, and we can use that to help in the case of someone like in direct-to-consumer. We will help them with television advertising and launch their first television national advertising campaigns, to serving as either a customer or even as a sales channel partner for someone if you're selling directly into business. So a lot of levers that we're able to pull on behalf of our companies and really provide value that exceeds just sort of the dollars, the initial investment dollars.
Makes sense. Well, thank you for the great introductions and giving our attendees more insight into what you all do. Now I want to dive right into it. Let's address the current issue. With a spotlight on social inequality, do you or any of the companies that you're working for have any new equal opportunity programs or initiatives supporting founders of color or minority-owned businesses or women-owned businesses, anything of that nature? Let's go ahead and dive right into that. And Vinay, let's start with you this time.
Sure. I mean, the answer is no, we don't have any new programs, but I think the bigger answer is we've long had programs, and both informal and formal. I mean, it's really in the DNA of the company that representation matters. The company, if you look internally, is predominantly females. If you look at the films that we've produced, are kind of very diverse from a gender perspective. If you look at the companies we've invested in, are also quite diverse from a gender and racial perspective. And so it's kind of, I don't know, it's always, without having an explicit mandate, it's always been an implicit mandate for us. Having said that, there are things that we do on top of that, because you do have to we've always felt that you have to over-index when you're talking about making sure underrepresented voices get heard, because as we are seeing throughout the world today, if people didn't know already, the deck is stacked against certain groups. So, we have kind of intern and extern programs focused on first-generation college students. We are partners with the NYC EDC Economic Development Corp, specifically to back New York-based companies founded by women and people of color. And we have kind of other programs like that throughout the company. So, I think what we're doing now is leaning heavily, even more harder into those. But, the nice thing is for us, that infrastructure was there. And so it's not necessarily about, announcing a new initiative this week or launching a new fund. And frankly, I welcome the stuff that SoftBank and Andreessen and others are doing. Better late than never, of course. But, for us, it's a little bit different.
That's great. And Chris, let's What about Comcast Ventures?
Sure. So, we have being able to support diverse founders has been something that we've always taken very seriously. We've had for, I think, the last 5 to 10 years, a platform called a sub fund called Catalyst Fund, specifically focused on minority founders. We've done several dozen investments out of that over the last, couple of years. And so it's definitely been something that is, that we think about, and we have a sort of an existing, to Vinay's point, was there before. And I think we're looking at how do we lean into that. One of the most important things when we talk about it is what is it that we do now? If there are changes, and what changes we make, how do we make those so that they're actually sustainable and things that follow through, so that when this is not on the front page, that we're able to commit to, to making changes and sort of something that lasts sort of going forward. So we are spending a lot of time sort of listening and thinking about what potential changes we could make. But we have backed, I think as a total portfolio, about 20%, 24% of our portfolio have women in their, as founders, which is
Great.
Still needs improvement, but, is better than many. And we have certain, it's an area where we do pay attention, and have worked with a number of organizations here in Los Angeles, Pledge LA, to, help increase sort of availability and access to startups, from people from those communities.
Thank you. And Holly.
Yeah, so I've worked at various places, and all the various places probably have very similar numbers in terms of women and people of color. I definitely think the gaming industry in general has to do a much better job. It's clear that the numbers are not good enough in my mind, and then even as I go on to the venture world, I still, like, after the Me Too movement, I'll be honest, I just feel like it's a checkbox at a lot of venture firms of like, I just need a woman, check. Oh, I need one person of color. And I think what a lot of people of color, or anybody in the minority is saying, it's not enough just to make, like, to count heads. You need to make those heads count. So in my mind, like, put them in positions of authority, put more than just one, because when you're just one at the table, you get drowned out so quickly that it's you need to, like, think about this stuff from the beginning. And the more and more I realize this is it's kind of hard to change if it's already there. Meaning, like, even at my own company, 25% of the founding team was a woman, right? And what's kind of interesting is about 25% of it reflected back. Our organization and the demographics really reflected back. We were a Chinese American team. We heavily had a lot of Asians. We were also in the Bay Area. We had ties to Berkeley. There's so many ways where, as a result, there was a lot of reflecting back. And I think there are ways in which, like, if you do start a new initiative within an organization, just make sure that is as diverse as possible, because once it starts growing, the inequities, it grows like a V, right? So, like, if in the beginning it's unequal, then it just gets worse and worse, and it gets harder and harder. And then it's to a point where now, if you can see all the systematic injustices and people are like, what can we do? It's pretty clear we should have been doing a lot of this stuff before, like, in my mind, like it should have been done before. It's just so sad that now is the time. It's like, oh, wow, okay, this is just, it's gotten so bad. And then I get torn, because I'm also like, well, then this is weird, because people are, like, now donating as if they're a charity case. These are people. Like, I don't even understand why, like, that is helping, where it's like, hey, let me donate. And I don't know, like, it just, to me, like, put them at the seat, put them on stage, put them, what do they say? It's like, make the hire, send the wire. Like,
Right.
And I think it's great. Like, fund the Black founders. I think it's wonderful. I think it's like, hey, let's focus on that. But, like, let's focus on our main deal flow being like 50% women and people of color and stuff. So sorry, I'll get off.
No. I mean, this
Get off the soapbox for a minute. But it is something that is being in an intersection of women and a minority. I am overrepresented in tech, being Asian, so I will call that out. But it just, I see it. I see it where I'm there as a head count, but not, my head does, like, I'm not included. And so just include us at the table.
Yes. Yes, totally agree. You know, if well, let's talk about some other issues now. Let's Holly, let's stay on you. Let's talk about Silicon Valley. Well, we won't. We'll
Silicon Valley, yes.
let's talk about a different topic here. Let's share with us some trends that you're seeing as far as VC dollars that are coming from Silicon Valley to Hollywood investments, or even tech founders who are investing with things of that nature.
Absolutely. So a couple things, like, I know we're not supposed to talk about the elephant in the room in the pandemic, but like, I certainly think with the pandemic, like, a lot of people, and you kind of saw it on Wall Street very briefly, they just didn't know what to expect. And when you don't know what to expect, like, the dollars get kind of like, you get a little bit worried and you kind of hold on and you don't spend because you're like, let's see how this thing shakes out. I do run a very small fund that invests in female founders for last batch that invested in just female founders from YC, and they were caught in the maelstrom of like, and the founders were amazing because they pivoted to an online demo day. There were still dollars that were going out for sure. Like, I know I deployed my entire fund, but that's the purpose of that particular fund is to deploy it for that batch. And in that respects, I definitely, for me, sitting on the investor side, I started thinking about, there are certain things that got started pre-COVID that I'm like, ooh, don't know, like a travel company or like events type thing where I'm like, hey, or weddings. And I think those tended to be a little bit more difficult. And then on the flip side, I think many of us in the investing world just saw crazy demand for remote work, delivery, ed tech, like all these things where technology. So it was like a tale of two cities in many ways. Even the ones that were just really small, baby, they just got inundated. Like if they were doing a delivery company, inundated, and they just couldn't keep up with the demand. I think now people have seen some of the shakeout. And so what you're finding is, I think the capital dollars are still going out, and people, all the VCs will say we're still open for business because nobody ever wants to turn off the flow, right? That's it's hard to turn back on. So if you're a founder looking for a check, I would say, make sure you're asking them, like, when was the last check you written? To what size was it? Last 3 checks, just to see what the pacing is for them and kind of how quickly are they able to write. A couple of things where I see, gaming definitely is pretty hot, as you talked about, as related to entertainment. Absolutely. There's definitely dollars that are going to entertainment. Masterclass just raised their Series E, right? And that is something
they raised quite a bit.
Yeah, they raised quite a bit. They had some really great tactical tips, and I had retweeted it, but I could send it out again. But like a couple of things that they said that I think is so true in this space is, especially if you're pre-seed, early seed, working the existing network that you already have is incredibly helpful. So definitely, like, you want to see who in your existing network maybe knows somebody and try to push really hard on that, because it's a little bit more difficult to meet, particularly early seed stage. Now, I'm talking about very particular types of VC-backed startups. There also is probably the world that Archer Gray plays in a little bit more, or maybe in Comcast, but where people would fund movie projects. I think that one's a little bit different. Silicon Valley has always been a little bit, ooh, I don't know. And they've seen that one more as like a donation, if you will.
Yeah.
And I will say, people from Hollywood would come up to Silicon Valley, and I would tell them, like, you have to approach it like you approach high net worth individuals where you're fundraising for a nonprofit cause, because they're going to want to know that, like, they can't fund it from their funds. They're looking for a certain type of return that honestly, mostly movies don't. And then the flip side of it is movies have undergone a ton of different impacting. You guys are closer about the theatrical release, but I mean, I'm seeing stuff on the AI side. Like, literally, you could make a movie with just like fake people. And it's kind of a little bit sad, because I think about every time I watch like a live action drama, I'm always like, I have a mix of savoring grief and sadness, because I'm like, I don't know when the next season's going to come back out again. Like, when is it going to be safe to film again?
Right.
I think the animation studios are going to be like totally fine if they could just crank more and more, but like, like I don't know. And I think you, Vinay, might know a lot more about that, as well as Chris, on certain things of like when it comes to Hollywood entertainment, like how does it impact it? But
Yeah.
we're still seeing dollars. It's just it's taking longer. I think the checks are smaller, but they're starting to ramp back up again. Like I see more people like raising, and some people are getting their stuff oversubscribed, like pre-seed stage, and I'm like, huh, all right, it's coming. Like
Yeah.
it's not back up to normal, but you kind of can see it also on Wall Street, like some of the things. And I feel like Wall Street is trading on a very different world sometimes than what Main Street is doing.
Yeah.
And
So let's jump
Yeah.
into Wall Street and New York in general. Vinay, since you are based in New York, we've got the Silicon
I
Valley.
represent all of Wall Street. Yeah.
You represent all of New York.
Let me talk on behalf of everyone. Yeah.
I mean, definitely, from a New York perspective, what are you seeing as far as financing, Hollywood startups and later stage companies, or even movies?
Yeah. Well, I'm going to partially ignore that question because I want to kind of pick up on what Holly was saying, and then I'll come back and I'll play nice and we'll answer the New York question. But I think the one thing that everybody is doing because of COVID, whether you're whatever industry you're in, one of many things that you're thinking about is like kind of how is the supply chain affected, whether you're selling toilet paper, whether you're making, whether you're Netflix. And I think one of the things that's really interesting about media broadly is that it exists on kind of two very different ends of a spectrum. On one end, $100 million Martin Scorsese film that needs 50 plus people to show up every day on set, shoot in close quarters, and all that is highly imperiled in this world. And the shadow that COVID is going to cast for many months is going to be long in terms of the ability to go back to making those things. So that supply chain completely disrupted. On the other hand, you have, John Krasinski making some good news inside of his living room. You have Masterclass, which doesn't need much. I mean, ideally it's shot on a studio, but it doesn't have to be a studio set. Somebody could do it at home with one crew member and a decent TikTok light. And you have all these, and TikTok and kind of all these other social platforms. And there had been this trend really, since the kind of dawn of modern social media of decentralizing the way in which content is created and even distributed. I mean, you think about media as the industry that brought us BitTorrent and stuff like that, which is literally kind of disintermediating big distribution companies, Comcast and Universal and so on. But, that kind of media wants to do that. It wants to kind of decentralize by itself. So I think for that reason, there's a lot of really interesting opportunities. And I think in some ways, people who are not media investors, VCs in Silicon Valley and elsewhere, who maybe weren't so focused on media are starting to realize now, like, oh, there's this is a really kind of, parts of it are quite COVID proof or pandemic proof or whatever the next crisis is around the corner proof. And also simultaneously, by the way, I think the 2019 stat was adults in the US spend more than 13 hours a day on media platforms across everything. That's TV, that's everything. But that's more than half the time. I mean, forget about the waking hours. That's like the majority of your your whole life. And I'm sure that went up the last month. So, I think the industry is getting more VC attention, and I'm really curious kind of to hear, Chris, you've been doing it for a while, and get the vantage point of both VC and the kind of media corporate. But I think people are kind of paying attention to media broadly. Media is a big term, more now than they had before. I guess maybe I'll pause there. We'll come back to New York maybe, but I'm kind of curious to hear Chris's take on what you're seeing.
Right,
yeah, I think there's a couple of things in sort of the media space. I mean, one, the tools, I would say we're almost at sort of the tail end of sort of V2 of video tools that are sort of broadly distributed. I mean, you had what sort of started with the beginning with an iPhone, and all of a sudden you had a camera and you had a video, but there's still like the tools necessary were pretty limited. You now look at what you can do, for example, on TikTok. It's much more sophisticated, but still relatively, it's not as easy, but you're starting to see a lot more product that takes away a lot of the back-end cumbersome, automates it through AI or machine learning, where the idea of premium content becomes so much easier than it was even 2 or 3 years ago. And so I think that as a result, the prosumer professional content, there's a lot more of that, and that's going to be sort of continue to accelerate, particularly driven by the issues related to COVID. I mean, to Vinay's point, a 50 person shoot would be easy relative to some of the other ones. And I think that, right now you look in there and say, like, look, how do you get content? How are you going to distribute it? And then ultimately, what is the nature of that content? How long and components? And you're starting to see, the emergence of those new narratives that are a convergence of things like sports, media, and gaming, whether it's Bandersnatch on Netflix or Telltale Games, where the interactivity is starting to become more endemic within the pieces. And I think that's sort of a result of people getting used to a level of high quality entertainment that is not just sit back, but lean in. And I think that you're going to continue to see more of that, particularly over the next 3 to 5 years.
Do you want me to answer the New York question now? I can answer the New York question.
Oh, yeah, sure. Get right to it.
It's interesting because not to generalize, but I guess that's the point of the question, is to generalize a little. I would say if we're talking about kind of venture-backed media companies, New York has been really good at producing the ones that are content-centric. So Vice, not that Vice is venture-backed per se, Gimlet, BuzzFeed, others that I'm now leaving out in the moment. And that's part of kind of a broader ecosystem of what New York, I think, is good at when it comes to content, which is perhaps the slightly edgier stuff, some of the niche stuff, some of the edgy stuff, A24, Neon are here, et cetera, et cetera. So those are businesses that are hard hit right now for a variety of reasons. Content costs a lot to make. It's now costing more to make, even the decentralized point notwithstanding that I just made, and advertising dollars are going down. So I think it's going to be tough. It's tough right now for a lot of those venture-backed companies that are already out in the world, like the ones I referenced, and I think it'll be hard to start new ones. So I think kind of in some ways, perhaps SF, Bay Area, and maybe LA too, have kind of, have a slight advantage right now in media, whereas I feel like we had a pretty good run in New York of kind of some really great companies. So it remains to be seen. The jury's still out of if that proves true, but that's kind of my feeling / concern, that the thing that New York was good at might not be the type of company that attracts dollars right now. Having said that, and I think this is going to be not a geographic-centric thing, I do think, and I think Holly made reference to this, like it's accelerated some trends in gaming. It's accelerated trends in kind of music streaming and the need for more and better data and infrastructure there. So I think it's also just going to start a whole new batch of really interesting companies that, I'm excited to see what founders come up with in the next 6 months. And I think there is a lot, it's a good, perfect storm. There's a lot of dry powder, a lot of firms raised, in the last 2 years, the kind of raising cycles for venture firms is accelerated, which means there's a lot of capital. So it's exactly what you would want in downturn for venture, which is a lot of dry powder and a totally disruptive force. It happened post 2008. It happened, unfortunately, post 2001. Unfortunate circumstances. And those are kind of the moments of innovation and also just from a venture return standpoint, those are the vintages that do the best. So I think it's going to be really interesting next 12 months in New York, elsewhere.
Just to build on, I think one of the things about the transition from sort of the Vice or the Vox of the world to now is the business model and what the business model is going forward, particularly from a revenue perspective, is going to be, critical. From a venture perspective, if your primary revenue source is advertising, that's not going to work. It's not sustainable. It's not going to get to venture, scales. And so there's a reason you see a lot of these companies moving to premium subscription, whether it's The Athletic in terms of content or even within gaming, not just doing single one-off purchases in games, but season passes, so you can get some level of recurring revenue that then subsequently Wall Street's going to value at a more sustainable rate because they think it looks the same as enterprise software, SaaS. I think there are going to be some interesting challenges in terms of, we talk about this a lot, obviously, at Comcast and NBC, but how many subscriptions are you willing to pay for? What is the quality of the content that you're willing to pay for? And, and how does that particularly work at a venture level in terms of the pure number of subscribers or revenue per user that you have to achieve in order to be able to justify, sort of that venture level of investment.
Well, speaking of subscriptions, with the distribution models and theatrical windows being heavily impacted by all of this, which streaming platforms do you think will win? And, maybe let's talk about what other types of technology platforms you think will rise from this disruption, perhaps better, in-home experiences, renewed interest in virtual reality, maybe some integrated partnerships between companies like Apple and Cinemark. I don't know. The list goes on. Let's talk about, streaming and distribution platforms and all that jazz.
I will say if VR, this is VR's time to shine. Like VR, blockchain, like crypto. Those are like the two
Right.
things. That I'm like, if they can't shine in this moment, I'm like, in my mind,
Yeah,
like,
this is the moment.
definitely two type of technologies that I'm like, it's time to step it up. So it'll be kind of interesting if like VR does come into the window. I know less about the theatrical and streaming, but I can see a world where there is a streaming, like, so right now it's super fragmented, right? Netflix needs to do their own watch party, HBO needs to do their own watch party, like, and I could see at some point, because I think reality is people don't care where the content is. That's just me. On the user side, I mean, they will go and they will start buying. I mean, I'll be honest, the first purchase I made in the pandemic was Disney Plus. I was like, oh yeah, we got to get that. They will buy it, but at some point, it is. I could see a place where what Hulu had done with all the networks, like there could be some streaming service that like combines all of it together, and in some ways replaces the theater, right? Like the in-person experience theater, and now I could have like a different type of theatrical release. It's very interesting. You guys might know a bit more about like maybe they just make more money without having a theatrical release. It goes straight to streaming because now people are at home. Reality is like people aren't going to stay at home totally as the bans get lifted. So I'll let you two talk on more like that.
Go ahead, Chris. I'll go after you.
Oh, I was going to say two things. I think one, I agree that they're not going to stay home, but certainly the experience in the theater in terms of density, I mean, it'll probably be, for the foreseeable future, you're at 30 to 40% of potentially of what you could actually see. But I think to your point, though, the experience of what it means to go to a movie theater will ultimately change. It is one of the things about it right now is that that experience hasn't changed. It hasn't changed in 80 years, 100 years. It's literally you versus the screen. It's one entire thing. And I think one of the areas that was sort of interesting is, there was a conversation at one point about, AMC buying AMC theaters. It makes no sense on it initially, but then what you realize is it's no different than the other distribution platform that they've made, with something like Twitch. They're going to create an omni-channel experience for their Prime members, where if you go there, they're going to be able to move in. I'm going to go to the movie theater. Oh, by the way, here's my pickup from my groceries. Here's my Amazon locker. Here's all these other premium experiences. Like you combine the Amazon bookstore, all into a single thing, and it becomes a multimedia, multi-experience. I don't know if that will happen, but I think that when you start thinking about it as too long, movie theaters have sat as the physical component sat as an isolated event, and it needs to be more integrated because that's how every other portion of the business has been.
So I wanted to kind of go back. I agree with all that, by the way. I'm not changing the subject because I don't really agree with that, but I wanted to go back to something Holly said about VR and blockchain, and this is like they're both those technologies moments to shine, and I couldn't agree more. But I'm curious to hear both of your perspectives on, there's been an unofficial or official, depending on the firm, moratorium on VR and blockchain after, many firms got burned by going maybe deep into those 3, 4, and 5 years ago. I'm wondering if the appetite is there to look past those kind of, again, typically unofficial moratoriums on investing in those spaces right now, because I agree, this is exactly their moment. This is what crypto was built for. And VR too, to some degree. So I'm just kind of curious. I mean, we never really, for us, had a kind of a moratorium per se, and I'm in particular interested in kind of what new crypto business models come up in media right now, because I think it's time. But I'm just curious how others feel.
I think the biggest question will be like, in their time. So that it's kind of funny. I feel like investors follow and the founders lead, and the users are on the forefront of that, right? Like the founders follow the users. And that's kind of what I mean, like in their moment of like, will the traction start shining? And I think it's kind of interesting. There are a couple of the blockchain stuff, and you kind of have to start building now, because you start thinking of a future of maybe hyperinflation, or does society become to a point where they need, weirdly, a trustless system? I'm always telling founders, please don't call it a trustless system. I want to trust my stuff. But sadly, in some countries, it's much more trusted. And currently, I will say with blockchain, crypto is probably like the biggest. Finance is probably like the biggest application. There's more, and there's other ones that they're trying to do it. And I think for blockchain, I think reality of the adoption will end up being that the founders still have to find product market fit, because people don't really care if it's on the blockchain or not. Maybe more and more will people care about like with their data and things like that until people start caring about it. So I really wonder, I'm not as close on like, hey, is adoption of VR a lot higher? Unclear right now. I don't know. I do think gaming is a lot higher. And it could be that VR itself is still too hard to use in some ways, in my mind. I mean, even with
Yeah.
the Oculus Go, I mean, it's like saying, hey, we all live underwater now. Well, we all live at the beach and everybody has to scuba dive, right? Like I have to learn how to put all that stuff on. Versus like snorkeling. Like I look at gaming, like PC gaming and mobile gaming as snorkeling, like super easy. I don't need to get certified. It's kind of one of those things. It's like everyone needs to be. Yeah, that's probably the analogy I have. So that's what I don't know if now a lot of VC dollars. I think now VC dollars will go that way if they see like some type of traction. Because I feel like they've plowed the money in to like build the infrastructure, and that's what I'm saying. Now it's the time to shine. Like our users moving into that direction. I don't know. I still think it might be over invested at this point. And we shall see, because this is the time for users to actually pick it up now.
Yeah, I mean, it was they both, but VR certainly suffered from sort of the irrational exuberance, the expectations getting way ahead of just the core underlying technology and its capabilities. I think it's interesting because I sort of separate VR/AR into two categories, and really think more on the consumer side, which is what we're talking about. I think it's still too early for that in a lot of ways, because it is too hard to use. There's not enough content out there. The quality of the content and the depth of the content is not deep enough from a value proposition to substitute for Disney Plus and a million other options that are a heck of a lot easier to use. I do think that where VR and AR have a potential interest in acceleration from COVID specifically is around components and enterprise. Whereas before it was maybe a hassle to send somebody, it's like, oh, it's inconvenient, but I'm gonna go ahead and send somebody to this remote office to do a presentation or a demo, whether it's learning or provide domain expertise. I think there comes a world where it's like, look, if you can have that person in the same way that we do, like say with drone pilots within the military, able to sit in one location and not have to have them all the way out and whatever the conflict zone. If those tools allow companies to decrease the risk to their employees in travel, cut those expenses down, and provide a higher level of quality, I think that most importantly, you have a consumer, the businesses that are willing to pay for that. And I think right now that the thing that VR needs more than anything else is people to pay for the product, and there just hasn't been enough of that. And on blockchain, we've and I've seen some things in VR that I think where I'm cautiously optimistic about that, but I think it's still. I think part of the question is like, which part of the when the new normal is sort of set, like how much do we revert back to previous behavior? Because it certainly feels like a missed opportunity. But I think part of that, frankly, is the companies, as opposed to say like venture funds right now, to Vinay and Hopper, like there's a lot of capital on the side and there's a lot of stuff to deploy to take advantage of this opportunity. The majority of the VR companies have a ton, don't have a ton of cash. They're sort of upside down financially. Like they're the legacy of what's happened the last 3 or 5 years. And so their ability to capitalize this from a resource perspective is just limited, relative to maybe somebody else who does have the cash and resources to do so. So I think that circumstances were better, but that the industry fundamentals are bad in terms of capitalizing. And on blockchain, I agree it's all going to be on fintech, because those are where the use case scenarios are the clearest. And I've told this. This is a question I've had many times with someone, like, why are you using blockchain as opposed to some other structured or unstructured database solution? Like, it sounds great, maybe, but it doesn't. and like, what's the additional value, and who ultimately is your customer? Because I think one of the things when you have someone who's really, someone like JP Morgan, who has its global, huge level complexity, they have to look at something like this. But your average company, even if it's like somewhere in healthcare, if blockchain is not just one step, but 2 or 3 steps in terms of the improvement of their quality, do they have the leadership? Do they have the culture? Do they have all the other things to actually be a viable customer? And I think in a lot of cases, the answer is no, because they're like, that sounds great. I just need my data to be accurate, and I'm not even there yet.
Well, let's talk about some of the other opportunities that might be emerging, or let's talk about consumer trends, consumption behavior as it relates to gaming and esports. With major sports being canceled, are more people tuning in to platforms like Twitch and might game watching become more mainstream, or is that again just because of where we are right this minute? And maybe Holly can answer that question on gaming. And
sure. Like, I think absolutely there is ways where your behavior is going to change as a result, and I think game watching might be one of them. I mean, Twitch is just posting like this type of growth. The kids are getting involved in gaming a lot earlier. We saw this not only with Fortnite, but now it's just getting accelerated because there's Animal Crossing is a great example. I could totally understand why watching it would be the next thing, because I turn on to ESPN and now I'm just watching like video game players racing instead of like the real racing. So I said, or cornhole, like that's my weird ones that I'm watching, climbing, cornhole. I was like, oh, I didn't even know that was a sport. So I absolutely think like that is probably one type of habit that will can actually stick and will kind of grow. I also think like what's just interesting is just the next generation of kids and kind of what they grew up on and the nostalgia. Like, I mean, I might be dating myself, but like Atari video games, like it's completely acceptable, and it's just going to be more and more acceptable, and especially if you just turn on to ESPN and that's really all that there is to watch right now, or reruns. That a lot of kids might be doing that. The funny thing is, I don't know if kids are watching ESPN. They might be doing.
No, they're not.
Right.
Exactly.
Right.
ESPN is kind of geared towards like older people, and maybe you can't really switch that for them. They might just be. No. I mean, it just might be hard. Like, I'm like, oh, I'm already watching the screen. Do I want to watch the screen of somebody watching a screen? Right. Mm-hmm. Like but that for kids, it might be just their outlet, like watching TikTok videos and things like that.
Yeah. And I the one thing that, we had talked about kind of in preparation for this call, and I'm just going to use Holly's point because I think it's a great point. And you were saying how kind of it takes 30 days to form a habit. So I think one of the things that's been different is that there's been this divide. There are gamers and kind of there's gamers, there's people who kind of watch other people gaming. There's an overlap in that group. And then there's everybody else. And, maybe everybody else kind of occasionally plays Candy Crush or kind of, dabbles in that, but wouldn't identify as a gamer. And now 2 things are happening. Everybody's at home, and the traditional media that maybe some people watch is not available. So they're looking for new things. And we are all just forced to be on our screens more. So whatever, either whether it's a kind of societal stigma or just like a physical stigma, it's like not fun to look at a screen all day long. That's gone, because it has to be gone. It's gone from kind of 3-year-olds up to 80-year-olds, up to 100-year-olds, frankly. And so, if you're on your screen all the time and you're kind of getting tired of doing the same old things, you're going to start trying new things, and you're going to be doing it now for 10 weeks and probably for the next several weeks. So I do think new habits have been formed and kind of new people have entered into that gaming ecosystem, either because they're playing it or they're watching it or both. And some will go back to kind of not being quote unquote gamers, but I think a lot will stay. So I do think it's been a fundamental phase shift for the gaming industry.
Yeah, I agree. I think one of the things about live sports is when you really look at what on average, that demographic, it's older and getting further older. If you were not interested in baseball before, watching an abbreviated season, you're just not going to do it. Like there's no, the chances of attracting new fans in this particular year, I think, and I do think that most of the big four and even maybe some of college sports, there's too much money involved. There's too many things at stake for those to not come back in some capacity. I don't know exactly when, but there's enough reason for people to try to figure it out in some capacity. Maybe it's not in front of live audiences, maybe it's in front of limited ones, but I think fundamentally, sort of what to Holly's point is, like, it's two different audiences. If you were 15 and you weren't really watching sports before, you're not going to be that interested in watching sports after this at all. It's going to be people who missed football. I mean, I'm looking forward to watching football. I'm not going to care about the NBA Finals this year. Like, makes no difference to me. Like, it's a weird season. It's irrelevant. And I think that the other thing about gaming and sort of about Twitch is that you're starting to see gaming and Twitch allows for a level of interaction between players and the audience in a way that traditional sports don't. And most games at this point are still designed to be played, not watched. I mean, I love League of Legends. I can't watch it to save my life.
Even with Overwatch, it's always so bouncy. Like, there might be something to your point, Chris, of like the divide will be like the kids can watch Fortnite. Like, Fortnite was built a little bit more mainstream to include men and women, or boys and girls. That now there could be a new generation of games that are just like much more like maybe we won't get any more GTAs as much.
Yep.
Sorry, that one's just much more like appealing to a particular type, or as complex as League of Legends, right? Like it's hard to play and it's hard to watch. Like, that just cuts out so many people that I'm wondering if the level of like more casual games like Roblox or even Star
like Rocket League was the perfect example.
Yeah.
I mean, it's two cars hitting a soccer ball. Like anyone can understand the rules. I think, I think that the thing that's really questioned, the big question for me to Vinay's point is the majority of the people who watch esports tend to be so hardcore that, like, does this shift the consumer behavior enough that your audience increases such that you could get a larger following for a next generation Rocket League or something that is not catering to those hardcore fans. I think that's the big that for me, that's one of the big questions out there, because that would be transformational if you did actually have an audience that was interested in watching those more casual games.
That totally makes sense. Catherine, I noticed that there were some questions.
Oh yeah, we're gonna dive right into that next, actually. First question up here. Thoughts on Quibi? Everybody.
I'll go with the caveat that I have not really watched many of the shows, but look, I think it's easy. There's a little bit of Schadenfreude here because of how much kind of chest pounding that team might have done, and just frankly, with all the capital they raised, they're an easy target. I guess what I would say is there's a long game here, right? Like, I wonder if people on this video conference would remember. I'm not putting the panelists on the spot, but just generally, like what the first Netflix original series was, what the first Amazon Prime original series was. I can almost guarantee it's not the ones that you think. It's not House of Cards. It's not Transparent. It's not Bosch. It's ones that probably didn't age well or weren't that. You got to kind of learn to crawl before you can run. And he has enough money. They have enough money to wait and figure it out. It was not a great launch. I think objectively, it is. No one will disagree with that. But I think the jury's still out. There's a lot of time, and there's smart people around that company.
Yeah, I think their first, well, I don't know. I think their first bullets might have been around a certain thesis that might have made a bit more sense in pre-COVID. Harder here, and it is your typical. This is what's interesting for founders out there who are just looking for product market fit. This is like your classic David and Goliath story where they raised a bunch of capital and all that, but their initial bet was off, and it depends on what they want to do and build the company around. And there's tons and tons of like stories that are littered with this. I mean, I guess I could pick on Amazon. Remember the Fire Phone? And they made their bet on 3D, and it just users didn't want it. Yeah, you're chuckling because it's like that wasn't it wasn't the problem to solve. Let's put it that way.
Mm.
But Chris, I'm very interested because you're a lot closer.
Yeah, I'm decidedly bearish, like apologetically bearish. I think for a number of reasons. I think one, I'm not entirely clear like what the problem. If you were to say, well, what is the problem that Quibi is trying to solve? I can't give you a good answer. It's not a shortage of content. There is more good content out there now than ever. And look, to Vinay's point, I totally agree. Like you actually look at the best shows. What was it? Was it Beta or Alpha? That was one of Amazon's first shows with like John Good.
Betas, betas, yeah, exactly. I had to look it up because I was like, also, if I'm going to make this point, I better know. But yeah, betas.
But it's so right. Like the first stuff was terrible. I mean, look, I think Apple arguably is having the same challenge. Like how much of their content is actually truly is actually good. Some of it's fine. I'll actually put a nod. I finally watched Little America. It's amazing. That's probably the best thing they have on there. It's actually very positive, life affirmational. Recommend that one. No vested interest, but I did really enjoy it. I like what problem are they solving? And I think one of the things that people have, particularly in the content media space, you're feeling like brand matters. And so within San Francisco and certainly in LA, New York, like sure, we talk about Quibi. But in Chicago, Houston, Dallas, Atlanta, like they don't care. And particularly at a time where part of the premise beforehand was like, look, we're going to get these really great actors, directors, the Spielbergs, et cetera. That the ability for a box office star to drive revenue has declined dramatically over the last 5 to 10 years. And I think that you're trying to build a brand and awareness when there's frankly so much else out there that's difficult. I mean, one of the big questions about Disney Plus is they clearly got there because of brand. They've had one really good new show, Mandalorian, and now the question simply is, what else am I watching it for? And unless you have kids, in which case you're watching Frozen for the 200th time. But that sort of highlights issues. Like they have an amazing brand. It almost doesn't matter what they're going to put out on there, but there's not enough of it. And so Quibi struggles from not really interesting content and no brand at a time where there's a lot of competition. And I don't see them as a technology play whatsoever.
And I wonder if that's in part the problem, not to spend 20 minutes on Quibi, but it's also easy to spend 20 minutes on Quibi. Because they raised money in the way they did, and because of the kind of Silicon Valley heritage, I think people are measuring them as a technology company. It's like, what's the problem you're going to solve? I agree. There is no problem. There's no problem, shortage of content. Also, I know how to pause Netflix. Like I can watch it on the subway and pause it 10 minutes and then watch it again. That's not a problem. But I think the idea of really high level content, like HBO level content, which whatever that means, but in a short form format, that doesn't exist. And if it's not a problem per se, but maybe that's a space. And again, I think this is the long kind of time will tell with Quibi. Is like, I don't know if you saw recently, there was a stat, I'm going to misquote it, but essentially the number one demographic watching Quibi right now is 50-year-old women, and they're gravitating towards the Chrissy Teigen show and the reality stuff, which is not where, I'm sure Jeffrey and Meg thought the audience was going to be, but they don't care. If that's where the audience is, I'm sure they'll go make more, Judge Judy-like shows for that audience. So I think they have enough money to figure it out. And we'll see. Maybe they shouldn't have raised so much money, but
I think that's my other thing. If you look at how much they've raised and what they've delivered to it, and then particularly say 2 months ago, look at what CBS Viacom was worth, or AMC networks or any of these other ones, like it just doesn't make any sense. I mean, that being said, for a lot of startups that are funded, but this one in particular, I really struggle with.
Yeah, it'll be interesting to see how they do pivot, considering they have so much money. Another question from Q&A here is from Mark Workman. Can you ask the panel how they see Peloton? That's an interesting one, actually. How do they see its technology and content as a precursor?
So I'll sort of jump on this real quick. So full disclosure, Comcast NBC actually has an investment in Peloton, so which is not Comcast Ventures, but actually.
Hopefully you're bullish on it then.
We are bullish. We are. We are very bullish on it, and for two reasons. It is a unique form of content that has, from our perspective, a hardware moat that, one, helps separate it from some of the other competitors, but also locks in your consumer for a longer period of time. Like once you've paid for that bike, the incremental value for that subscription of that is you've already made that upfront commitment. And I think, look, they've had a huge surge as a result of COVID. And the other part about it is that the nature of the product is such that the secondary market is fantastic. If you're done with it, that bike may get bought by your neighbor, and then they're going to have to pay for a subscription as well to really get the value out of it. So you sort of continue to have your LTV on a per bike basis is actually pretty good. There's no doubt in my mind that the numbers that they've had the last 2 to 3 months are probably unsustainable, but I do think that it also did accelerate the adoption of it for a lot of people who wouldn't. I mean, my parents before COVID, they're 74 years old, and they both use the Peloton at home. They've been using it for 6+ months. I mean, they love it. And I think the fact that it's been made accessible even for an audience like them really suggests that the market size is long-term pretty remarkable.
I think it's also one of the lessons I've learned as a VC, which has nothing to do with media, but is never bet against cyclists. Like the cycling community is crazy. Like I would not have seen, I'll admit, if Peloton came to me, which it didn't, at the time, I wouldn't have seen it. I passed, everybody has the empty portfolio, passed on a company called Swift, which essentially was, you put on VR goggles, you sat on your stationary bike, and you could kind of be in the Alps or be wherever. And to their credit, they pivoted away from VR, which is, I think, made them so successful, and they're a fairly direct competitor to Peloton now. And then, I don't know, my Soho coffee shop that I go to is the cycling store Rafa, which some people might be familiar with, which is like a super high-end niche bike shop that the Walton family, the Walmart family, put like $400 million into. So yeah, just like don't bet against cyclists.
Here's another question. Yesterday's Department of Labor guidance regarding private equity and 401k. Did you guys hear that? Can you repeat?
Yeah, I don't know what the Department of Labor guidance is right now.
I guess they had some DOL guidance come out yesterday. Does anybody have any opinions on that or thoughts?
I didn't.
Not familiar enough.
I haven't reviewed it. No, sorry.
It's all good. We skip. We move on to the next.
The next panel can be all about that.
So there's a lot of content creators in the audience. And so a question here is from Shameen Davis. Are there business models you think content creators are overlooking? A while ago you talked about how, Silicon Valley doesn't really want to invest in movies, things of that nature. Like, could there be, I guess a more innovative play beyond just here, invest in my content?
Well, I think you see some of it, and Archer Gray probably is on the forefront of seeing a lot of these, like the crowdfunding sites. Patreon was a new business model for a lot of creators. There's one called Gumroad that kind of appeals to folks that aren't your typical movie makers, but they like create ebooks or something, and you want to monetize that. So I absolutely think that there's probably room for kind of what Archer Gray is investing in. So I'll turn to Vinay, because I feel like you probably see a lot more different types of business models for creators to monetize their creations.
Thanks for that plug. I'll take it. But I think, there's a lot of toggling happening. Yeah, I mean, companies like Patreons and platforms like that are super interesting, and exactly actually the types of, 99 Designs, these types of platforms that empower creatives are very much the types of things we want to invest in. But I think, and maybe I'm wrong, the question was maybe more around, I'm trying to make a series, I'm trying to make a movie. I go and pitch people in LA or anywhere. I pitch them, and they say this is super risky, and chances are I'm going to lose all my money. And I think Holly, you made the point. So like almost see it as charity, and you want to get out of that cycle, and you want to try and make a kind of a business case for the creative content. And I guess I would say, sorry to be negative, it's hard. It's hard to kind of the version of that then is you kind of figure out a studio, right? You make yourself a studio, and there are examples of modern day kind of studios that go well. I mean, Quibi is a modern day studio. It's not going that great because content is hard. Content is hard to make creatively. It's hard to make from a business standpoint. And when you layer lots of content on top of each other, you're kind of multiplying that risk. I mean, there is a little bit of a hedge, but it's multiplying the risk because now you're running a business too. And running businesses are hard. Running early stage businesses are really hard. And making a great piece of content, whether it's a movie or even a YouTube video, is hard. And so it's one of the reasons why, frankly, we don't invest with our VC hats on, at least, into those types of content rich or content dependent companies. We will do one-off investments. So we will, there are certain parts of the risk that we're comfortable with and certain things we won't do. And we've decided as a company where we're comfortable, and so has the next financier, and so has the next financier. So it's more about kind of figuring out who are the people that have demonstrated that they're comfortable with the type of risk that takes to make the thing you're making, and go find them. I think it goes to Holly's point, is kind of ask what check or look at what checks they've written. If they haven't invested in $10 million, movies, I'm just making this up, don't assume they're going to invest in your $10 million movie, because they've decided they're not comfortable with that risk, no matter how much they love your script.
Yeah.
All right. Let's move on to one more question on Q&A here. General question from Ian Sharp. What do you see for the economy in the months ahead? Crystal balls? Anybody? Crystal balls?
I'm going to take notes. Yeah, please tell us.
Crystal balls. I mean, there's a lot of unsurety. There's a lot of unclear. But the interesting thing for now, people talk about the second wave. There's currently a lot of unrest in terms of protests. It's unclear how long it will take for the economy to bounce back. This is not financial advice, and I don't even know. But I'm just like, it's pretty clear that the Wall Street trades on something quite different. And I think what it trades on, well, not trades on, but one of the things is when it hits expectations or not. The interesting thing is I feel like the pandemic, everybody's like, okay, we didn't know what a pandemic was like, but now we know. We've spent 2 to 3 months in it already. So when the second wave does hit, it doesn't feel as unfamiliar, sadly. So I don't know. I think it'll be bad. I don't know when the economy will recover. It's pretty clear though that people the government wants to write stimulus check. Well, I don't know how clear it is and if it's enough or if it's going to the right people. So that is something. But they were very quick on writing the stimulus bills across the world. And then at some point that probably leads to hyperinflation if the economy can't keep up with it. I don't know if that's clear enough, but I'm just oh, that's kind of interesting. And I could be very wrong, but I'm just realizing oh yeah, it's usually when people don't know that is what's really hard.
Yeah. And I think to bring it kind of maybe back to the focus of this panel, the thing I kind of wonder about is, we're in kind of the short-term solution, which is there's been stimulus money, the unemployment money has kind of come faster and is higher. And some people had savings. And so, they took some of that savings and they bought a Peloton bike because they're home more, or, they've kind of spent it to adjust for their new normal. But if this is long or if there's kind of reoccurrences or both, people will run out of kind of funds and the government will run out of stimulus funds and people will start to feel, real economic pain if they haven't already. And a lot of people have, but those of us that maybe had the luxury of a few months before we feel it, will feel it. And what goes away then? Does the Disney Plus subscription go away? Again, bringing it back to kind of the topic of this, what gets cut? And I don't know, but something has to get cut out of budgets. So I think that's something that I'm keeping my eye on is, what goes and what stays.
Well, you guys talked about, dry powder, how there is still dry powder out there for anybody that doesn't know what that is. Basically, available money that can be deployed. And even NVCA mentioned that there's, even as of last year, $121 billion in dry powder. And obviously there are still some investments being made. So, how can founders looking for capital approach VCs nowadays? It seems that, you guys are actively taking Zoom calls. What's effective, and how are deals getting closed now? What's working? What approaches work?
So I've mainly dealt in like 3 early seed stage like incubators. They're totally open to open applications. So Y Combinator is one of them. Mozilla Y Combinator is already started their summer batch. They also do a startup program where a startup school where anybody can apply. You don't have to apply; you just sign up and you get access to education and all of that stuff. Mozilla, though, still has an open incubator where you just apply. And as long as they're looking for ideas and startups, tech startups, they are looking for tech startups that support the mission of Mozilla, which is to keep it free and open. So there is capital out there, particularly if you're doing a tech found startup. Mm-hmm. And then I also am a big fan of, but this is just me, people should reach out. Don't do something dumb of like, hey, it's a cold email and it's a copy and paste. But like, if you're very smart, very targeted, or you can get an intro, that's something that a lot of people can do. But like the open applications are really good because we also see how the networks can get like kind of overcrowded. And if you are doing a tech startup, please feel free to DM me on Twitter. It's Holly H. Liu, Liu, and I'll send it there. Feel free to DM me. I'm open to taking calls with founders.
Great. Thank you for that, Holly. What about you, gentlemen? How can they approach your companies as far as if they have, whether it's a new startup or even an existing late stage company that, might not have, or their PPPs run out, but they are, looking to pivot and they've got, the next great thing. How do they approach you guys?
I can go first. I actually also really like kind of DMs on Twitter. There's something just elegant about it. And also it stays away from all the noise of the inbox. My Twitter is Vinay NYC, New York City. And yeah, I think to echo what Holly said, this is a really great, like all the kind of typical networking channel, not all, a lot of the typical networking channels have been kind of imperiled by COVID, for better or worse, and I think maybe for better. And so, you should reach out, but know who you're reaching out to, right? The caveat is kind of use Crunchbase, use the other kind of resources to understand as best you can, what the thesis is, and reach out to the people that feel like a fit. But otherwise, yeah, go for it. This is the right time, right? People can't meet you at a conference. People can't do the kind of random serendipitous run-in that, might happen otherwise. So reach out.
Yeah, I sort of echo all of that. I mean, Twitter definitely works for me. LinkedIn usually works, although I tend to that is an inbox that does fall behind with a lot of things. And I'm just Chill Climber on Twitter, CHILL Climber. I think warm intros or sort of having a connection, and I think to Vinay sort of touched on this in a couple places, being very clear about with each investor, like what are they looking for and what are they looking for now and how has that changed? Both Holly touched on this as well, but have they made investments recently? How are they thinking about COVID? If someone were to tell me like, oh, my plan hasn't changed in the last 10 weeks, like that's probably means we're gonna not work well together, because I would sort of hope that you'd have some sort of response to that. But it does create. There's definitely been companies that are seeing opportunities that they otherwise would not. And that there is, going back, there are people who are interested in new content and new companies in a way right now that they wouldn't normally previously be. And so I think that there is definitely that receptivity.
Right. Well, I think, there's a few more questions, but since we've run out of time, you guys all know how to reach our speakers. If you have any questions, DM them on Twitter. I want to thank each and every one of you for taking the time to chat with us today. I know these are busy times and you guys are on demand all the time, so we appreciate it. And to our attendees who tuned in, thank you as well for continuing to support Winston Baker Small Business. Feel free to donate on the donate button. And also continue to register for our virtual conferences. Up next, we've got Film Finance Forum, at Cannes, the virtual summit. We're also going to be doing an immersive summit to talk about virtual reality, augmented reality, and all of XR in the next couple of weeks. And one more thing, next week, we've got a nice webinar with special guests from India to do a session on the new Bollywood. So hopefully we'll continue to see everybody online. Everybody stay safe, stay healthy, and thank you.
Thank you. Take care, everyone.